Hello and welcome to Switzer Investing Insights, brought to you by nabtrade. And today we're going to talk about hybrids. We'll call this Hybrid Securities 101. Paul, let's start off with the most obvious question. What are hybrids?
Well, a bit like the hybrid car, Peter, the Prius, it's a cross between a debt security and an equity security. They're like debt in that they pay a regular income, they have a notional term, and if you invest $100, you should get back, if things work out well, $100 at the end of the investment. They're like equity and they're classified as capital by the issuer. The investor is at risk, so potentially you could lose all your investment.
It sounds dramatic, doesn't it?
It does sound a bit dramatic, but that's some of the risk you take on. And they trade on the ASX like a share.
Okay, so who issues hybrids and why do they do it?
Okay, typically hybrids are issued by the major banks, but also they're issued by insurance companies and some other corporates. The main reason, Peter, is that APRA allows the banks to classify certain hybrid securities as additional Tier 1 capital. They're cheaper for the bank to issue than traditional capital. So, for example, if you issue ordinary shares, shareholders demand a return on equity of around about 12 to 14%. But the cost of issuing a hybrid security is typically more like around about 7 to 9%. So it's actually cheaper for the bank to issue capital through a hybrid security than through an ordinary share. And the market we're issuing into, of course, is largely a retail market on the ASX. Banks also have choices. They can issue hybrid securities through unlisted markets to wholesale investors directly. So this is just an option for them to actually raise capital.
Okay. All right, Paul, let's go through a typical bank hybrid.
Well, typically they pay a floating rate distribution, and that's paid every quarter. And usually it's a fully franked dividend. The distribution is reset each quarter at a fixed margin over a benchmark rate. That benchmark rate, again, is typically the 90-day bank bill rate, which has a very strong correlation to at least the RBA cash rate, and that's adjusted for franking. They have a mandatory conversion date, typically 7 to 10 years out. Now, on that date, unless things are going really astray, the bank is required to convert the hybrid securities and give you ordinary shares in exchange for your investment.
Which can be fantastic if the bank's actually flying since you actually went into the hybrid.
Yeah, it can be, but probably that won't necessarily in your best interest, but let's just move on. There's also an optional call date. Now, that's typically about 5 to 7 years out. And that option is for the issuer, and they're allowed to redeem the hybrid security by paying you back your $100 or alternatively giving you shares. And then in really dire situations, APRA, that's the regulator, can require that the banks mandatorily convert the hybrid security into ordinary shares. Now, if that happens, you as an investor,
your worst fears have been realised.
Your worst fears are going to be realised. There are things called non-viability triggers, and because the number of shares you might get is capped, you could be really badly off if that happens. So this is where the capital features come into them. They are quoted on the ASX. They have a 5-digit stock code. Typically the first 3 digits relate to the underlying bank, the fourth is a P, and the fifth is just the mnemonic for the series. So for example, CBAPG or WBCPF are examples of a couple of hybrid securities listed on the ASX.
Okay, let's go through how the distributions are actually calculated.
Okay, the distribution it's a fixed margin over the bank bill adjusted for the franking. So let's take an example. Let's say the margin on the hybrid security is 4%, the 90-day bank bill is currently 2%, and the dividend is going to be fully franked. The way the dividend is calculated is the margin of 4% is added to the current bank bill of 2% to give 6%. That's multiplied by 0.7. And effectively you'll get a fully franked dividend yield of 4.2%. Grossed up, that'll be the same as 6%. So that's effectively what it's doing. Now, if interest rates subsequently go up, let's say the 90-day bank bill goes up to 3%, then the dividend you'll get will be 7% times 0.7, and that'll now be 4.9%. So it's gone up from 4.2% fully franked to 4.9%.
So rising interest rates can be rewarding for someone holding
so if you
a
invest
hybrid.
in a hybrid security and interest rates go up, the cash rate goes up, the bill rate should also go up. That means your dividend each quarter will be higher.
Okay.
But conversely, Peter, if the bank bill rate falls to say 1%, the RBA cuts rates and the 90-day bank bill rate falls as well, then the dividend would be effectively 3.5%. So that's the downside of potentially of investing in effectively like a floating rate security like a hybrid.
All right, let's go through the myths associated with hybrids.
Okay, well, the first one is they're like an ordinary share. Well, they are sort of like an ordinary share in the sense that you've got the same downside risk. So if you invest in shares, you can lose all your money. And potentially that could happen in the worst situation for a hybrid security. Where they're unlike an ordinary share, of course, is there's no upside. If you invest $100 in a hybrid security and all goes well, you'll get $100 back at the end of it.
The reward is only the
there is no
distribution.
capital gain here,
Yeah.
unlike investing in shares. So that's where they're not like an ordinary share.
Okay, safer than shares?
Well, not really. I mean, on the pecking order, if again, in the event of a wind-up of a bank, they rate a level above ordinary shareholders. But if that's happening, Peter, I think you're going to lose your money anyhow. So they're as safe as an ordinary share, but they're not safer.
Some people say they're risky.
Well, they're as risky as an ordinary share. They're certainly complex, and hence the need for this video. And of course, there's lots of things in hybrid securities you need to understand. But look, I don't think they're risky, but I certainly think they're complex.
Distributions are guaranteed.
Well, then distributions are not guaranteed, so they are subject to payment conditions. So in other words, the bank has to be making profit, and APRA can stop the bank from paying a distribution. They're also non-cumulative. That means if they miss one quarter, and it goes for a period of time before they're able to then pay another distribution. They don't have to make up what they've missed in the past. The only protection for hybrid investors, of course, is what's known as the dividend stopper, and that means that the bank is not allowed to pay a dividend on its ordinary shares while it's got distributions outstanding on hybrid securities.
Lots of ifs and buts. With
Lots
hybrids.
of ifs and buts, and that's one of the complexities. As I said, they're complex, they're not necessarily risky.
Finally, let's go through how to invest and the pricing.
Well, I think the first thing I mentioned, they're complex, Peter, and you and I believe never invest in something you don't understand.
Yep,
now,
I agree.
if you don't want to understand hybrid securities, don't even think about investing in them. If you do, would strongly encourage you to have a look at the ASIC's Money Smart website. The address is on the screen. They've got some really good information about hybrid securities.
Okay. Well, Paul, let's just talk about diversification in hybrids.
Well, I think that's the important part about managing risk. So I think if you're going to invest in hybrid securities, look to build a portfolio, and that means diversifying across issuers, Peter. So although our banks are related, but if one bank gets into real trouble, it may not impact the other banks, and that's as you as a hybrid investor can be insulated a little bit. So diversification, don't put all your eggs in the one basket.
Okay.
The
And let's finish up on pricing.
Yeah, so the underlying price, of course, is what we call the margin. And I mentioned the fixed margin, the example was 4%. Look, historically, those margins have varied between about a low of 2.8% and a high of about 5.2%. At the moment, they're in the mid-threes. So, they're sort of mid-range. So look at the margin. You can also look at the secondary market, the so-called trading margin, which is effectively a comparison or a way to convert the two. But the margins, of course, vary, and will vary in particular over time amongst other factors, including supply and demand. So when new issues come into the market, typically the prices of the old issues go down. So that's something to be wary of. It is a market that really where the banks are a little opportunistic in because they're only raising capital when it suits them and at a good price. So it's in their interest, not necessarily in your interest, so you need to sort of follow the margins.
But let's get personal here. You're in hybrids, aren't you?
Yeah, I invest in hybrid securities. I treat them as part of my so-called risky fixed interest portfolio. And I like them, but I do diversify and I do look at the margin closely. And sometimes, Peter, you can buy better hybrids at a better price on the secondary market than you can in the new issue market. Okay. So there are opportunities in the way they trade on the ASX.
Well, I think it's a great explanation of hybrids, Paul. So that's Switzer Investing Insights brought to you by nabtrade. Thanks for joining us.